Good morning from London. I'm Anna Edwards alongside Kriti Gupta and Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. In the banking sector, HSBC announces a $3 billion buyback while Santander beats profit estimates. We'll speak to Santander's CFO shortly. In other earnings, Adidas and Lufthansa surpass expectations while Novartis raises its full-year guidance once again. We'll hear from the drug maker's CEO after the market open. Plus, Goldman CEO David Solomon is bullish on deal-making. He still sees reason, though, for caution. He spoke to Bloomberg exclusively at the Future Investment Initiative in Riyadh.
You know, if you took a tour around the world, the U.S. economy is actually doing quite well. It's been very, very resilient. I'm a little bit more concerned about European growth and also the economic situation in China.
Checking in on these markets, we have traders continuing to brace for the US election. Futures pointing higher in Europe. The 10-year US Treasury yield continuing to climb on this Trump trade. The Bitcoin number, $71,000, past that for the first time since June. And the yen also at 153 per dollar as the Japanese Prime Minister promises a return of political stability. The countdown to the opening trade starts right now.
October the 29th. We are in the midst of earnings palooza on both sides of the Atlantic. We're, of course, waiting those big tech earnings over in the States. But in the meantime, we're getting plenty of earnings right here in Europe, Anna.
Yeah, absolutely. Let's start with BP, shall we? So the energy giant reporting third quarter adjusted net profit, 2.27 billion. So that's better than was anticipated at 2.05 billion. So that number coming in better than expected. Net debt drifting up a little, but perhaps the fact that some of the other profit numbers have outperformed. We see that the debt gearing number not too far above estimates, but it is just slightly. So debt gearing at 23.3%. The estimate was for 23%. So we do see them beating on the net level. We see the operating cash flow coming in above expectations, the net profit, the EPS, all of that then beating expectations, coming in really strongly. But of course, looking ahead and even looking just back over the last few days or so, the focus has really been on the weakness in energy prices broadly. 71.39 is where we trade on Brent. Of course, we all know the geopolitical developments of the weekend that weighed yesterday on oil prices, and now a lot of focus will turn to OPEC Plus and watching what they're doing. Of course, a lot of focus also on buybacks in this sector, and once again we see them going ahead with that $1.75 billion worth of share buyback for the third quarter, and that is in line with some of the estimates that we were seeing. Any guidance they give on 25 though, and the pace at which they plan to maintain those buybacks, that'll be crucially watched.
Absolutely, and this comes in the context, of course, of these massive profits that all the energy companies have really been seeing. It's not just BP, it's Shell, it's Exxon and Chevron in the States as well. This is really fueling the idea, Lizzy, of the kind of windfall taxes around the energy complex as well, that if there's so many profits to actually be able to tax that. But in the context of what Anna was just saying, if you do see a fall in energy prices, maybe that eliminates that kind of appetite for buybacks, and maybe that also eliminates the appetite for those windfall taxes.
Yeah, and speaking of buybacks, that takes us to the earnings from HSBC as well, coming out this morning. A great big $3 billion buyback announced by them.
Yeah, it's a really fascinating one here. I mean, look, a little bit of a mixed picture, because on the surface, these pre-tax numbers were quite strong, and yet you didn't actually see that much when you look into the nitty-gritty in terms of actually what is driving these sales and these revenue numbers. I think this is significant here, specifically when we talk about their net interest income, because that's where you're seeing a little bit of decline. You're seeing their net interest margin shrink as well. They are sticking with their guidance. You're right. They're hitting that $3 billion share buyback as well. But look, they're in the midst of a restructuring. How many times we started the show, Anna, with this idea that we are actually getting new headlines, a new strategy from HSBC, similar to what we're seeing in Citibank.
Yeah, absolutely. And we are saying this is paying off under the new CEO. OK, he's new to the role, really, but this is his first set of earnings. But the share price has responded positively in the Asia session. The Hong Kong shares of HSBC up by more than 3%. So the positivity around this pre-tax profit beat, the size of the buyback, all continues. Real uncertainty, though, around the holdings in China. On the one hand, the stimulus in China paying off already in terms of the amount of money going into equity trading, wealthy clients putting money at risk in that space. But they've got a stake in BOCOM, the Bank of Communication, and there are a lot of people focused on the recapitalisation of that and what that means for the bank, for HSBC. So that's one of the earnings stories we follow this morning.
Yeah, of course, the broader bank story is the pivot to lower interest rates and what that will look like in the future. So you had Santander beating profit estimates thanks to that continued growth in interest income, rising revenue from fees as well. Now we look ahead to how much lower interest rates will hurt them, and we have already the discussion of job cuts here in the UK and how much they can maintain momentum this year and next. But
No, I was just saying, crucially, will they take a hit on this Court of Appeal decision on Friday around the level of disclosure required on deal commissions when it comes to auto loans, to motor finance? And that's something that sort of came from left field for a lot of the players in this space, but it weighed on some of them on Friday, and we certainly see it having an impact on Santander because they had to delay some of the earnings report.
Yeah, we should mention that the chairman of the company, Anna Botín, actually, I think spoke to Bloomberg over in Washington, I want to say a couple weeks ago, actually expecting a lot of those auto loans to really pick up post-election. I'm curious about the sentiment
US,
story.
yes.
And a lot of that, maybe we'll ask the CFO in just a few minutes.
Indeed. Just coming back to the oil price drop that you saw in on the Middle East politics yesterday that you mentioned, Anna, that lifted the airline stocks. We have had also results from Lufthansa this morning. The expectation going into it was that the airlines are going to be dragged down by rising costs and limited planes, given all the woes at Boeing and Airbus as well on the delivery delays. In fact, you saw Lufthansa confirming its guidance, so strong demand seen through the end of the year. It could be another good day for the stock, not just because of the oil price drop yesterday. We also got Novartis boosting its profit forecast for the third straight quarter. We've had the shares up 18% already this year. And just finally, out of Germany as well, Adidas confirming guidance from October the 15th.
Yeah, so a host of corporates really taken by the Novartis numbers, and we're going to be speaking to management there. Of course, the US election, a bit of an unknown when it comes to working out the prospects for such businesses. Patent expiration, always close to these conversations, and Bloomberg Intelligence talking about a lack of clarity, really, as to when they really kick in. Yeah, the Pluvicto drug, of course, front and centre for that company, and whether or not we see that sustainability there. The election is certainly a key one. I'm going to come back to Lufthansa, which is the point that you made, Lizzy, and I think this one's really crucial. It's a shame Guy Johnson isn't here, because this is right up his alley. When you're talking about what the company actually said here, it's all about deliveries of new aircrafts, not being able to keep up with that capacity, not to mention those labor issues. Where are we hearing that? We're hearing that in Boeing. We're hearing that in other airline makers as well, all feeding back into the parent company at Lufthansa. OK, and we continue to track the Boeing story, of course, with their capital raise. Let's tell you what is coming up on this programme. On the show today, we are going to be having that earnings conversation, speaking to the Santander CFO, Jose Garcia-Cantera. That's coming up shortly this hour. Don't miss our conversation with the Novartis CEO, Vas Narasimhan. He'll be speaking to the programme later on. At the market open, Mark Dowding will be with us, RBC Bluebay's CIO. A host of topics globally to cover, all, of course, with the US election hanging over them. The Future Investments Initiative Deputy CEO of the National Bank of Kuwait will be with us. That's from FII, the Future Investment Initiative in Riyadh, and we'll have plenty of coverage coming through from there, monitoring all of the panel conversations that are taking place there as well. Plus, we're going to be speaking to the Flint Global Senior Advisor on US-EU relations as we count down, Kriti, to the US election, certainly keeping our focus on everything that's happening domestically, what that means for the US economy, but then that transatlantic read across into European politics as well. Yeah, it's really going to be a crucial one. And speaking of the United States, there's plenty going on in just the next 24 hours stateside, where we're going to look from the earnings picture to, of course, the US data as well. We'll start there. 2 p.m. US time. You get those jolts. UK time. You get that consumer confidence number. That is about 10 a.m. US time, of course, where we're going to see on the East Coast. And that's going to really give us a little bit more idea in terms of the labor market. But then it feels like all the ramp up is really going towards the earnings picture we're going to get. We're going to get some consumer earnings, McDonald's, Chipotle, Visa, PayPal, of course, but then also some of those tech earnings, Alphabet, AMD, even Snapchat. Two very different sides of the equation, Anna, two very different reads. Yeah, absolutely. Alphabet will be really interesting. Google parents, of course, expecting to see revenues higher, profits higher. We're watching the cloud business. How the search business is faring, though, with ChatGPT and all of those, that new angle on the search product, that will certainly be crucial to watch, even if analysts expecting that Google maintains its hold of that market for now. But AMD really fascinating from the PCs and service side, but their attempts to compete with NVIDIA on accelerators, AI accelerators, that's got to be a a real focus for markets and a real, the thing that we're watching for this week when it comes to the AI story.
Yeah, I mean, broadly, every time you get earnings, the AI contribution gets more real. So that will be front and centre when it comes to Alphabet. Also seeing YouTube winning more market share among younger viewers. But I hate to mention this at 7 a.m, but McDonald's earnings, it'll be interesting to see how much of the E. coli contribution we see in the outlook as well.
Well, for McDonald's, the currency impact is really crucial there. Remember, 60% of their revenue comes from abroad. So if we're talking about the strong dollar narrative in the markets, McDonald's is where it shows up. For Google, it's going to be interesting. In the last 24 hours, Microsoft has actually made accusations against Alphabet, saying they're trying to undermine their market. Remember, they're both trying to get that cloud dominance, and that's really crucial. AWS and Azure, however you want to say it, have the major kind of dominant share there. Alphabet is the one that's trying to make it up. So we'll see how much they can chip away at that.
OK, let's get to some of the other top stories this morning. Israel's parliament has passed a bill to sharply restrict the main United Nations organisation supporting Palestinians, further threatening the already slow flow of humanitarian aid to Gaza. The decision to all but ban the UN Relief and Works Agency comes despite calls by many of Israel's allies not to move forward with the legislation. The Biden administration has finalised restrictions on US investments into advanced technology in China. The rules ban some investments into semiconductors, quantum computing and AI. The policy aims to prevent US capital from helping China develop critical technologies that could give Beijing a military edge. And Ford shares tumbled after the bell on a warning that full-year earnings will fall to about $10 billion, the low end of its forecast. The car maker is struggling to cut costs and overcome supply disruptions caused in part by recent hurricanes. The Ford CEO, Jim Farley, says the EV unit is the main drag on the whole company. Well, those are some of the stories to watch out for this morning. It takes us, the Ford earnings, to the woes that continue at VW. The crisis really deepening yesterday. The news that they're going to close at least 3 plants, cut thousands of jobs, slash wages. It really is unprecedented news from the German car maker.
Yeah, absolutely. So the German car maker very much in focus with that in mind. It's interesting that that news out of Ford can take us into the German auto sector. It can also take us on the macro level into the jobs report that's due out Friday, because there was the hurricane impact was certainly writ large over what Ford was telling us. And if that's something that is increasingly or more widespread, seen across the United States, and maybe a more reluctance to hire as a result of the hurricane impact. And that's going to be something that, when it comes to the Friday jobs report, will be focused on. Yeah, absolutely. And this is where the wages is really crucial as well, because, of course, not only are they shutting down this plant, they're taking a 10% universal pay cut. They're suspending some of those wage increases into 2025 and 2026, not to mention layoffs as well in Germany. But then this is where the labor story really keeps an eye on, a crucial eye on kind of what's going on in the U.S. economy, because it's not just about how many jobs are added, it's about how quickly those wages are increasing ahead of that crucial U.S. election as well, which in these last couple of days of campaigning has been a hot topic on the campaign trail. OK, coming up on the programme, more from Bloomberg's exclusive interview with the Goldman CEO, David Solomon. That from Riyadh, of course. We'll hear about his bullish deal-making outlook and plenty more from the boss of Goldman Sachs. Plus, the Novartis CEO joins the show to give us the latest from the company's upbeat earnings. Up next, though, we'll be talking to Santander's CFO. Join us to break down the bank's earnings and more. If you have any questions for our guests, please do get in touch. IB plus BBTV Go. That's the function that we will be, of course, are always monitoring to see if you want to participate in our conversations. We've mentioned the FII a few times this morning, the Future Investments Initiative. Well, BlackRock's Larry Fink, Citadel's Ken Griffin, Blackstone's Steve Schwarzman, and others are on stage at the FII in Riyadh. A reminder that you can watch the event on your terminal using the function Live Go.
Their children will work there or might want to work there themselves. What's the best way to get a job at Citadel? What are you looking for in your people you're hiring?
So we'll have about 100,000 college applicants this year, and a STEM background is really helpful to get a job at Citadel. We find that students that have a strong background in engineering, in mathematics, sciences, that can understand how to frame and solve a problem are the students that excel within our four walls.
Okay. Go to Paul Hudson. Paul.
Welcome back to the programme. 7:17 in London, and we have a positive picture on display for the futures market this morning, expecting to see some modest gains at the start of trade. A lot of earnings reports coming in this morning. Let's get to one of those. Santander has posted better than expected profit in the third quarter. Net interest income at the Madrid-based bank gained from a year earlier, but dipped from the previous 3 months, missing estimates on that particular number. Let's bring in Jose Garcia-Cantera, the CFO of Santander, once again on the programme with us. Jose, very nice to see you again on this programme. Let me ask you about the way that the rates environment is playing out for you. There's a lot of expectation around the sector. You know, you and others have done well on the back of higher interest rates in that environment, and now rates coming down. What are you expecting to see? How will that play out for Santander?
Good morning. It's a pleasure to be here again. We had another strong quarter, record profits of 3.3 billion in the quarter, 9.3 billion in the first 9 months of the year. That's equivalent to a 16.2% return on tangible equity. The main reason for these is the very strong performance of our operating model. We added 5 million new customers in the last 12 months to a total of 171 million customers. And these customers are using Santander more and more as their primary bank. So obviously, in the future, as rates stabilize or come down, we would not expect to see such a growth, the same performance in NII that we've seen in the past. But the fact that we are adding new customers, we are transforming the model, we are becoming more efficient. The cost to income in the first 9 months of the year was 41.7%, which is best in class, with cost actually down in real terms. All of this is the consequence of our operating model, our transformation, and this is sustainable. This is independent from the level of interest rate. So we remain very constructive about the future of our operating income and our profits next year.
And can I ask you about some developments in the UK, Jose, because I know that you've had to delay some of the announcements around the UK business today. You say that the judgment from the Court of Appeal sets a higher bar for the disclosure of and consent to the existence, nature and amount of any commission paid by a lender. So this is to do with motor financing, and a verdict we had that maybe blindsided the sector a little bit at the end of last week. Jose, some analysts are suggesting this could add up to a more than £1 billion hit to Santander. Is that the right ballpark of figure to be thinking about?
Well, the ruling of the Court of Appeal came out on Thursday, and we need time to assess the impact on our UK business. Also, we would expect some guidance from the Supreme Court. You know that the ruling was appealed. So we need time, again, to assess the impact on our UK business. But we are certain, and we are quite sure that this is not going to be material for the group, and that our targets for this year will not be much affected, and we will meet the targets that we've communicated to the market for the whole year.
OK, so not material. What separates material from non-material, Jose?
Well, it is the size of the impact in terms of net income. Materiality is around, let's say, 600 million. So we expect an impact that is going to be significantly lower than that.
Jose, a couple of weeks ago, your colleague Anna Botín made some really interesting comments to Bloomberg, talking about more in the car space, expecting some of those auto loans and the car financing to increase post-election. Give us a margin there. How much gains are we talking about in the U.S. market, given that so much of Santander's focus is now there?
Consumer lending and auto finance is highly dependent on the level of interest rates. We run that business not with sensitivity to rates, but obviously this is a business that is highly sensitive to interest rates in terms of volumes. The lower the rates, the more the volumes, the more active customers are asking for consumer loans and auto loans. So as rates come down in the US, we expect the auto finance business to gain momentum next year. And obviously, ahead of the elections, customers are a little bit, let's say, cautious. After the elections, with lower rates, we expect 2 more cuts in the US before the end of the year, 2 more cuts of 25 basis points. We expect the auto finance business again next year to pick up momentum.
So in addition to the 2 more cuts, let's put that aside for a second in terms of the interest rate story. It looks as Santander is also investing a lot in their investment bank activity, competing in the United States with the more traditional Wall Street players. Talk to us about how Santander remains competitive. I know you're investing a lot there, but how do you do it in terms of fee structure, given you're competing with people who have existing relationships in the United States right now? How does Santander compete?
Well, we don't want to compete with the big U.S. investment banks. We are a corporate bank that wants to take advantage of its presence in the U.S., in Latin America, and in Europe. Lots of companies, many companies operate in the 3 regions, and we can offer services in the 3 regions. That's our competitive advantage. We want to take advantage of that, of our geographical presence, and the fact that we are one of the strongest banks in infrastructure investments for climate change, for instance. So we again don't want to be competing with the large U.S. investment banks. In fact, you know, we talk about significant investments in the U.S. We are still a very small operation by any standards in the U.S. But the most important thing is our focus is corporate banking. Our focus is customers with which we can work and add value. And again, no need or no aim to compete with these big U.S. banks.
Well, Jose, let's bring it back to the interest rate story. Then you say a lot of your exposure, as well as not maybe just in the United States, but in Latin America as well, is what sets Santander apart. But put that in context of the U.S. election. Do you see fund flows or any of your picture there, your exposure to LatAm changing as a function of the U.S. election?
Well, the U.S. election is going to happen in just a few days, so we will know the result in just a few days. We are operating in all these countries to serve our customers. We are not seeing any special outflows or inflows or non, let's say, that we cannot explain as sort of the seasonality, the seasonal factors or other factors. So we are not seeing any particular special outflows or inflows related to that. In the meantime, again, we are working to help our customers in Mexico, in the US, in Brazil, in Europe, like we always do.
Jose, I just want to bring it back quickly to the UK, because, of course, we've got the budget coming tomorrow from Chancellor Rachel Reeves. The British payment group, Ebury, which you back, has been talking about sounding out potential investors for an IPO. You said some months going public isn't necessarily the best option. I wonder if there's anything Rachel Reeves could do to change your mind, or if you already have changed your mind on that.
No, I don't think there is any news there. We have no further comments at this point. I think when we have something to add, we will definitely communicate the market, but there's no news at this point.
And you're cutting jobs in the UK. Are there going to be more job cuts elsewhere?
Well, we are adjusting our operating model to the banking reality. At the end, we are investing in common platforms, a common operating model, a new core banking system that is fully digital, that operates in a digital form, in the cloud. So obviously we need to adjust our operating models, not in the UK, everywhere, to this reality. But again, at the same time, we are investing in these new technologies. We are investing in the UK also through these new platforms, global platforms and technologies that we are developing for the group as a whole.
OK, thank you so much. Jose Garcia-Cantera, CFO at Santander, reports out, earnings out this morning. We thank you for joining us, as always. Coming up on the programme, we're going to head back to the Future Investment Initiative in Riyadh. We're going to catch up with the Deputy CEO of the National Bank of Kuwait. Plenty of interesting conversations to bring you out of Riyadh, so do stay with us. This is Bloomberg.
Eduardo Saverin may not be as well known to everybody here as some of the other people. Let me just give you a brief introduction. Eduardo was a student.
30 minutes away from the start of the opening trade across Europe. We are seeing green on the screen when it comes to that futures picture. Some major outperformance when it comes to that French index, higher by almost 0.8%. We're going to dive into the details as we get closer and closer to those opening trades. In the meantime, let's go to some comments made from the Goldman Sachs CEO, who's talked up the underlying resilience, the improving outlook of the American economy. We spoke exclusively to David Solomon on the sidelines of Saudi Arabia's Futures Investment Initiative. Take a listen.
I think there's an awful lot of attention on short-term rates. I'd actually be focused over time on longer-term rates. And, I continue to be concerned about the level of spending and deficits in the United States. I don't think that's a short-term, crisis factor. But unless we have policy change and get our spending and our debt under control, ultimately that's going to have a bigger impact on long-term rates than I think people are anticipating today. With respect to the short end of the curve, I think it's going to be very data dependent, and that data will be driven in part by what kind of policy we see coming out of the election. Yeah. And so I think it's important to watch carefully. It seems like the Fed has been relatively transparent that we'll get another interest rate cut before the end of the year, but after that, I think it will be very data dependent on what kind of policy implementation, what happens to growth, are the inflation numbers actually improving further? Those are all things I think the Fed will be watching carefully.
Can I just circle back to your first point vis-a-vis spending, though? 10-year Treasury is trading around 4.3%. Do you think that is adequately pricing in the fiscal premium in the years to come in the U.S.?
The market's the market, and so it is absolutely pricing in the premium that the market perceives today. What I would just say, if you look at the trajectory of our spending and our debt and the interest burden that we have, I think over time is through the rest of the decade, et cetera, we'll have to bring new buyers into U.S. Treasuries, and that will potentially have a risk of putting pressure on longer rates, unless we want to finance the whole Treasury stack at the front end of the curve, which would be a very, very significant policy shift.
Goldman Sachs CEO David Solomon there speaking exclusively to Bloomberg in Riyadh. Look, he's pricing in one Fed cut before the end of the year. Santander CFO just told us 2 before the end of the year. They're not really thinking about the election, but so many markets guests around this table have said, well, the election's going to determine the path of the Fed.
And I suppose you can see a nod to the election, the comments that we're getting from the likes of Solomon around the deficit. And we also heard Jamie Dimon speaking about the deficit earlier as well. Dimon talking about the scale of it. Solomon there saying we need to get that debt under control. Dimon going on to talk about how he sees a lot of things that could be inflationary. So back to your point about how many cuts we get from central bankers, that's increasingly on the radar. And Dimon listed a host of reasons why we might see further inflation coming back.
Well, Solomon did talk about his concerns about the Middle East conflict. Of course he did. He's in Riyadh. But he says it hasn't had that significant impact on the business yet. Be interesting to see how much of an inflationary impact it has in the future.
Yeah, it's going to be a crucial one. Of course, at the same time, Citadel's Ken Griffin also saying he expects Trump to win the U.S. election. So some big names making some big calls over in Riyadh. Let's go back to Riyadh, where Bloomberg's Jumana Bersechi is standing by with the guests. Jumana, over to you.
Hi, ladies. Yeah, so it's all kicking off here at FII. And as we speak, by the way, there's a plenary going on behind me, which explains why there are so many people here. But I have another special guest lined up with us right now. And I'm speaking to Shaikha Al-Bahar, who is the Deputy CEO of National Bank of Kuwait. Wonderful to have you with us. We spend a lot of time talking about the GCC economies, and we talk about Saudi Arabia, we talk about Qatar, we talk about UAE. I've got to be honest, not so much about Kuwait, but you do tell me that things are changing and the Kuwaiti economy is on the up. So just give us your outlook for the Kuwaiti economy.
Yeah, Kuwait economy is on the rise. Basically, after the Emir decision or Emiri decree to dissolve the parliament, change in Kuwait is, very much seen, and now the government is serious to rock the boat and bring a lot of, activities to Kuwait and to push all the contracts. This an area for international contractors to be part of, building the infrastructure and to accelerate, the movement in terms of project. Luckily, this year, 2024, the total number of awarded contracts, 22 contracts totaling $6 billion, and in the pipeline approved or closed around another $5 billion project. So this tells you about the activity that we're going to have in Kuwait. And this, of course, create opportunities for banks to lend and create opportunity for the subcontractors, the local contractors, and other, small active clients in the market. So we are very, very optimistic this time.
It sounds like you really believe the government is committed to reforms this time around, and therefore very positive about the outlook for the Kuwaiti economy.
Yeah, I very agree. I agree on that.
Yeah.
And we are seeing it. Now they are talking about, introducing tax, VAT, to make it, a real economy that, have the contribution of the nation and the people living in Kuwait, So reforms, we're going to see it soon. Definitely they'll look at all the utilities like, fuel, water, electricity, and so on. So this will help in creating, a reliable nation that will contribute to the community. And of course, this will open the horizon to the private sector, because it's a way to implement the vision of 2035, which is basically focus on the contribution of the private sector and the government to be just a regulator and policy maker, while the operation or the operator will be the private sector.
There's been quite a lot of banking consolidation going on within Kuwait. You talk about the likes of Buyback and Gulf Bank, KFH and AUB merger. How do you see the outlook for the Gulf Banking Association here?
Yeah. Well, now there is talk between, or discussions between Buyback, our Islamic arm, and this, by the way, differentiates MBK from the rest of the banks within the country. MBK is the only bank who offers the two platforms, the commercial banking, conventional banking, as well as the Islamic banking. Before we acquired Buyback, the Islamic bank, we used to lose business to the Islamic banks. Now, we channel this business to Buyback, our bank. Regarding the talks of Buyback Gulf Bank, we are supportive, but not unconditional support. All depends on, the added value to our shareholders, and of course it has to make sense. It's just started. Now they will start with due diligence, and then they'll agree on the price and so on. It's too early to talk about it.
One of the big themes that I've picked up on since I moved over to the region about 6 months ago is we've been talking about the sheer amount of deal making and activity and IPOs that are taking place in Saudi Arabia and UAE, and I'm just curious to hear about the outlook for the IPO pipeline within Kuwait. What do you see happening there?
Yeah. Well, regarding the IPOs, used to be, very, very active in a small scale, family companies. While in Kuwait now, they are talking about the PPP model, and this is basically partnership with the public and private sector. Ultimately, such companies will go to the market. So this will help a lot, the activities in the stock market and the marketplace. So I'm positive. Still, I believe a lot of family businesses will go to the market, because just to make the continuity is affirmed for these family businesses, and we've seen too many families are interested in listing their businesses to make sure that they have succession plan, they have good executive management, they have governance, they have clear strategy, and so on. So basically, I believe we're going to see more and more activities with this, positive environment in Kuwait.
Well, you say the positive environment within Kuwait, but what about the broader regional environment? What is the level of concern about the regional geopolitics right now? How much of a concern is it for businesses operating in Kuwait?
Well, basically, we've been through the geopolitics risk for such a long time. It's not something new. So, I don't want to say it's like business as usual. Yes, it has some challenges, but basically, GCC, it's not like other countries. We have the means, we have the sovereign wealth fund that help, the economy. and support the private sector as well. So during the crisis, like Corona, for instance, they supported most of industries, let's say, banks and SMEs and other industries by, facilitating and, minimizing the restrictions, the ratios, and so on, just to help the economy. So whenever it's needed by, the interference or support by the government, we will see it. And we've seen it in Kuwait. For instance, in the crisis 2008, the first thing that Central Bank of Kuwait did is the guarantee of deposits.
Yeah.
Unlike others in law.
Yeah. So you're here in Saudi, and offline you were telling me, I think this is your first time to FII.
Yeah.
So I'm assuming there maybe is some business to be done. What are you looking to do in Saudi Arabia? Do you have access to some Saudi projects? What is the plan here?
Yeah. Well, basically, let me tell you, MBK is a global bank that have 13 presence in the worldwide. We are in GCC, we are in the Middle East, we are in Europe and States. So the focus is basically in GCC and mainly Saudi Arabia. We have branches in Saudi Arabia, and we have the wealth management. This is, the drive of, fees, and this is a great, let's say, product to maximize and increase the bottom line for the bank and the shareholders as well. So we've been involved in the too many projects in Saudi, and we have great relationship with big corporates, with quasi government companies, and we are financing a lot of big projects. And basically, the growth in MBK loan book comes from combination of IBG, domestic corporate and retail, but definitely big weight to the IBG or International Banking Group, and mainly Saudi. So we have two strong presence for us. Egypt, our second home market, as well as Saudi, our market that we are now focusing on. I'm now with my team. It's a big delegation. Basically is to have one-on-one meeting with the clients, creating a lot of deals and bilateral deals and so on. And they are doing a very good job. I'm watching them. So it's really great.
I'm sure you are watching them. Just a final question for you, because we talk about the broader global macro context. The Federal Reserve has started cutting interest rates, and of course many of the currencies in the GCC are pegged to the USD. What sort of knock-on effects are lower interest rates in the US going to have on the banks over here?
Yeah. Well, basically, yes, it will impact the interest income.
Yeah.
But it will open the space for everybody to borrow. As you know, a lot of clients are shying away because of the high interest rate. Yes, on the deposits and so on, I agree. But a lot of borrowers, and especially with the big projects, they prefer to postpone, their investment or their projects due to the high interest rate. Now, with the interest rate cut, and I think this will be a new horizon that will create opportunities for banks to lend and finance opportunities.
Well, you said New Horizons, not me. By the way, that is the title of this year's FII theme. It's called New Horizons. Shaikha, thank you so much for your time. It's really nice to chat to you. That was Shaikha Al-Bahar, the Deputy CEO of the National Bank of Kuwait. Ladies, I'll toss it back to you in the studio.
A really interesting perspective on the ripple effects of Fed cuts in the Middle East. Bloomberg Horizons anchor Jumana Basechi in Riyadh, we thank you for that conversation. And we're going to have more from the Future Investment Initiative annual conference later in the day, including interviews with Saudi Arabia's investment minister. And a reminder that you can watch all of the event on your terminal. Just go to Live Go. There's plenty more. This is Bloomberg.
I think when he started in 2016, this was completely new territory. Most people who are president, have no idea what that job's really like because it's so different than any other job.
inflation, in my view, may not go away so quickly, okay? And so you might go into next year, 2026, where it starts ticking up a little bit like it did in the 70s. Huge fiscal spending. The remilitarization of the world, which is inflationary. Demographics is inflationary. The green economy is inflationary. The restructuring of trade is inflationary. So I see a lot of inflationary things in front of us.
Get the picture. A lot of inflationary things in front of him. Jamie Dimon, JP Morgan CEO, of course, speaking at the American Bankers Association annual convention. Joining us now to think about markets, and we'll feed that inflation theme into the conversation, Rachel Evans, managing editor for FX and rates coverage for the US and EMEA here at Bloomberg. Let's talk about the markets in 3 minutes then, Rachel. And let's start with that inflationary read. I mean, we have lots of conversations around this desk about these various themes and how they might lead to some sort of pickup in inflation. Meanwhile, the market is obsessed with how many rate cuts we get, of course.
Yeah, and I think Dimon is exactly right to pinpoint this question of do we see a resurgence in inflation, because that is what the Fed is really going to be looking at. It's why we've really seen over the last kind of few weeks that whole sort of enthusiasm towards, you know, loads and loads of rate cuts really being pulled back, and people getting a little bit more moderate with how they kind of see the inflationary picture. And I think one of the sort of things that he alluded to that's really overhanging all of that, beyond kind of some of the longer term sort of demographic type sort of causes of inflation, is this idea of fiscal spending. And it was the first thing that Dimon mentioned in that clip. And I think that's where you kind of sort of see that connection point to what the other big event that we have beyond the Fed at the moment, which is really this US election drama. And really, whether you see kind of Trump or Harris kind of emerge victorious next week, we do expect to see kind of more spending. And that really does suggest that we're going to see a rising deficit and potentially more inflation kind of coming through.
Yeah, you've seen the Trump trades rallying, long dollar, short rates. With the race this tight, I just wonder how much more room there is to get in on that this side of the result.
Yeah, we're actually starting to see some on Wall Street taking a little bit of money out of those trades. There was an interesting commentary from Société Générale, I think earlier this week, looking at kind of the 30-year space. We've seen, as you said, long bonds in particular selling off kind of on these inflation, fiscal sort of spending kind of fears. And possibly they've gone a little bit too far. So SocGen was recommending people sort of, you know, actually maybe think about going into 30-year debt. So there is that question mark. But we did then see, of course, today, Bitcoin going past $71,000 for the first time since June. So there is still some room in certain trades, but it's a question of where you want to put your money. And do you really want to be going big into some of these trades that have been so widely flagged for such a long time?
We'll talk about the trades more. Where in the curve is going to be the most volatile in the next, say, 10 days?
Ooh, it's a really good question. I mean, I think we've been seeing kind of a lot of volatility focused on the 10-year space just because it's so liquid and it's such a benchmark.
It's the easy answer, Rachel.
It's a very easy answer. But I do think that the short end is also worth watching, because if we think about kind of all the different sort of things that are going to be jostling the bond market, yes, you have the election, and there you've got kind of an argument for potentially a haven play or for buying kind of the 10-year on that. But if you think about kind of what else we've got a ton of data. We've got non-farm payrolls on Friday. We've got the Federal Reserve meeting on Thursday next week, so just 2 days after the election, when we may not even still know the result. There's going to be an awful lot of scrutiny about exactly where the Fed is going. Do they cut at this meeting, and do they then signal that they are going to cut again in December? And then what do we look like for next year? So I think there's going to be a lot of volatility across the curve, but I would actually look at the short end as well as the 10.
Yeah, but driven by two very different factors, right? The short end, of course, all the way out to the 30-year. Rachel Evans, Bloomberg's managing editor for FX and rates coverage for the U.S. and EMEA. We thank you so much. Let's go from the macro to the micro. Get our stocks to watch from Joe Easton from our equities team. Joe.
Morning, Kriti. So a couple of big banks out with numbers today. Firstly, we've got HSBC looking really strong, rising almost 4% over in Hong Kong in terms of the stock listed there. Now they're doing a $3 billion buyback, and their earnings from their lending look pretty solid as well. That has been a bit of an underperformer given concerns around the Chinese economy, but potentially we might see some of that gap narrowing this morning. Then the other big one, Santander. Now their lending numbers looking good in Spain and Latin America as well for the company. That's been a bit of a better performing stock. But the thing to note in this one, as you guys were discussing with the CFO a few moments ago, is they've delayed the UK part of their results due to this ruling on Friday around the motor financing. So this was all about how the commissions paid to brokers that were doing deals on car loans was disclosed, and Santander Santander, as a result, are delaying their UK part of their results. Now, on the screen here, we can see the UK business, almost 10% of group revenue, so it is a significant amount of their business. So that could potentially take the sting out of the positive numbers this morning. Then over in the oil and gas space, we've got BP. Now, this company doing a $1.75 billion buyback. That is potentially better than expected because they have seen weakness in their oil refining business recently, and the gas business does look a bit stronger in terms of where that money is coming from at the moment. But that stock has underperformed the old rival Shell, as we can see on the screen here. A lot of concern around the net debt for this one, and there's actually been a $1 billion increase in their net debt in the last quarter, according to the company, so that won't help on the outlook for that one. Then in terms of healthcare, we've got Novartis, strong sales in oncology and also in skin drugs as well, according to the firm, but the valuation on that one looking a bit punchy at the moment, and as such, not too many people are willing to be on the buy side. We've got holds, 17 holds, and a couple of significant sells, with Barclays being one of those. Still 10 buys though on that one, but potentially not the strongest in terms of where the valuation is sitting at the moment. Then in terms of rating changes, Philips loses its only sell following that plunge yesterday. Jefferies upgrading that one. ABB over in the automation space in Switzerland. That one's cut at Goldman. And another one which could be weak today, Temenos in software, downgraded to underperform at Oddo. All of those could also be in focus this morning.
Joe, thank you. Our equities reporter, Joe Easton there. Another couple of stocks to mention. Vinci, the construction business, winning a contract. Schibsted, one of the shareholders in that publishing business, deciding to sell some of its stake. So we'll continue to watch that. More broadly, though, the futures picture looks positive this morning.
Yeah, pretty positive. Green across the screen. Some outperformance in France, though, higher by 0.7% on those CAC futures. The underperformer is even higher as well. We're looking at the kind of the IBEX there, and that's even also higher by 0.3%. We're going to dive into that and all of the opening trades on the macro and the micro conversation next. Plenty ahead. Stick with us. This is Bloomberg.
Welcome back, everybody. This is the opening trade. A few minutes until that opening trade here in Europe for the Tuesday morning. This is Monday's session. Not sure it gives us much of a clue as to where we go today because of the range of earnings stories we're dealing with this morning. But for what it's worth, we saw some strength into the end of the European session, and US stocks closed near their session lows. So in normal circumstances, all else being equal, we could have expected that to put a little downward pressure on the start of the European trading day. But perhaps the buybacks from the banking sector and from the energy sector, maybe that will give us a little bit of positivity. Certainly the futures picture, Kriti, looking as if we'll get a bit of that positivity. Waiting to see if we get any guidance on buybacks in 2025 and how much resilience we see around that theme, certainly from the energy space. But for the moment, expectations are we go higher at the start of trade.
Green on the screen in the futures picture, Anna, really supporting that thesis. It feels like there's a party about to start in a couple of minutes when we hit the European trade. For me, it's a lot of the concentration is going to be in French stocks, so higher by 0.6%, almost 0.8% earlier in the session. The outperformance in France has been a theme we've seen in the last couple of days, despite some of the beating that's taken in the lead up to that. Lizzy, that's where my focus is going to be at the opening trade.
Yeah, and if you look under the hood, a lot of that positivity likely to come from the earnings story. So we've had HSBC announcing this fresh $3 billion buyback and better than expected earnings. Novartis boosting its profit forecast for the third straight quarter. Shares already up 18% this year, so really outperforming European pharma. And then you've got Lufthansa confirming its guidance, seeing strong demand through the end of the year. But those shares benefited from that cheaper oil day yesterday because of the Middle East geopolitics. Could we actually see a reversal of that today, despite these relatively healthy earnings, Anna?
Yes, and worth noting that in terms of yesterday's session, the way we come into today's session, energy was a real underperformer yesterday on the back of that weaker oil price. Does the buyback from BP, does that do anything to change that this morning? So the markets are open this morning, this Tuesday, and we are looking for a bit of that upside then. Kriti was talking us through the futures picture, and we are looking for stocks to go a little bit higher here in Europe. So the FTSE 100 out of the gates, and it is higher by just 0.2%, waiting for the other markets to open up. The stock 600 overall up by 0.1%. We've got that buyback theme running through from a number of the heavyweight sectors in Europe. But also some other earnings stories. Lizzy was talking about Novartis. That could be something that applies some upward pressure, although we're getting fairly accustomed to beats and beat and raise from Novartis in particular. The CAC 40 is open and is up by around 0.5%, so kind of on a par with many of the other markets. The IBEX in Spain up by 0.4%. So broadly speaking then, Kriti, we see some strength, modest strength perhaps coming through across these equity markets as we really are in the heart of the earnings story today.
We really are, but at the heart of that earnings story, it's a tale of two commodities. And I think this is really interesting here because when you look at the FTSE 100, your biggest underperformer, your biggest weight on the index is coming from BP. Those numbers that kind of share buyback really not impressing investors. That kind of drop down you're seeing in the revenue numbers, also not a good one. But then to the upside, some of your biggest outperformers are the likes of Shell, for example. So again, maybe there's a little bit of a inverse trade there. HSBC as well, taking the cake from an index perspective, higher by 2% when it comes to the FTSE 100. And it feels like that's kind of the theme that a lot of these banking stocks and the rest of the market is really taking their cue from, Lizzy. And that's going to be crucial in terms of just some of the early kind of movement we're seeing in the earnings picture.
Yeah, so bearing in mind that we're still waiting for the DAX to open, if you break it down by sector across the stock 600, you've got all but two sectors in positive territory. Banks, as you say, leading the gains, higher 0.8%, really getting a boost from those HSBC earnings. But bottom of the basket, you've got basic resources and travel and leisure, only just in the red there. But if we look at some of these other stocks that are moving at the open, you've got, I wanted to know, Danone, because you were talking about the outperformance in the futures picture of the CAC.
Yeah.
And actually, this comes down to China, the Chinese government vowing more support for families with children. So Danone getting a little boost in Paris, higher 0.3% there.
Yeah, so that's one to watch. Keeping an eye on BP, and we are seeing a bit of negativity there. Now, they came out with a buyback that was in line with what the market was looking for, but there was an expectation, perhaps we get a bit of guidance around 2025 in the buyback. They're actually saying today that they're going to review the buyback plan in February, so we have to wait a little bit longer for that strategy update. And also the debt pile just growing a little bit, and that remains something of a preoccupation for those invested in BP.
Well, let's take a little bit of a quick check on some of the, you mentioned the outperformance of the French stocks as well. The only downside movers on the CAC 40 this morning are Renault and Stellantis. I think this is interesting. There's a little bit of a car theme there that we're seeing, perhaps a hangover from the Volkswagen story yesterday, continuing to be under pressure. The DAX is also open. Seeing green on screen there. Adidas, higher by 2%. We're going to dive into some of the earnings stories in just a moment as well. But for the meantime, let's get a little bit of a 30,000-foot picture. Mark Dowding, CIO at RBC Bluebay Fixed Income, joins us around the table. You've picked a great day to join us. There's a lot of green on the screen, so the energy is high here. Let's start talking a little bit about how the bond market plays into the equity market story. And we say this in that we're in the countdown to the U.S. election. The bond market is very, shall I say, volatile at the moment, doesn't really know what to do or what to price in. Where on the curve could you see the most movement going into November 5th?
Well, so a great question there. I think the first thing that you'd say in terms of the interplay is that actually over the course of the past month, you've actually seen yields rising, largely because the US economy has been doing so well, hasn't it? Data has been relatively strong. And ultimately, we need to remember all the time when it comes to equities as an asset class, it's all about earnings growing, as you're hearing about earnings growing this morning. And so if we've got growth, then that's going to lead to high corporate earnings. You're going to see equities in the green, aren't you? But in terms of the question, in terms about the part of the bond market that's going to matter next week the most, I actually think that in terms of the economic outlook, it looks pretty upbeat, relatively speaking, in the US under either Harris or Trump for the time being. Actually, some of the biggest changes could actually be more around foreign policy or trade. So I could actually see more volatility in FX markets than in fixed income markets. I would say, though, that if we do see Trump, do expect to see more of an impetus towards curve steepening, particularly if he ends up managing to make the sweep. That's the scenario that investors haven't really been thinking about thus far. I know markets have been starting to price a bit of a Trump victory, but if we did see a Republican sweep, that could be something that gives some of those Trump trades even more impetus than we've seen over the course of the past week.
So what does that Trump trade do then to the Fed trade? And I say this in the aspect or the angle of, we've heard from the likes of Jamie Dimon, David Solomon, among others, that the inflationary risks are more to the upside. Take geopolitical risk, take the deficit risk, the risk of tariffs as well. Does that cushion any move in the bond market as a function of a Fed cut?
Yeah, so in terms of the Fed, I think very clearly we're going to see the Fed cut again in November. If they don't cut in November, it ends up looking like the September move was a mistake. Doing 50 was a mistake. So I think 25 should be baked in the cake. But it's kind of interesting. If you look cumulatively at the next two Fed meetings, you've got around 42 basis points of cuts being priced. And so that expresses some degree of uncertainty whether we're going to see a follow-on cut in December. And I think that further sort of rate cuts are going to be much more data dependent. At the moment, it looks like the economy is doing really well. The stock market's had a high. Credit markets are doing well. This economy doesn't need a lot more sort of monetary stimulus. So from that point of view, I'm not sure that we'll be seeing a lot more in terms of Fed rate cuts in the months ahead, unless there's a much more material slowing of the economy.
Mark, you've written about the potential hit to the Eurozone economy from Trump tariffs. If he is elected, I wonder how soon you reckon it would light a fire under the ECB to get in there with a bigger jumbo cut?
I think that's a really good question. So I would say here that if we end up with Trump winning, obviously he doesn't take office until January, does he? So thereafter, I think it's going to be a couple of months before we see actually anything done on tariffs. All of that said, I think the fact that Trump takes office is going to be a catalyst for maybe Christine Lagarde to get her revenge in early. Why not go for 50 in December? Actually, I mentioned the pricing of the Fed over the next two meetings. In the ECB, you're pricing now 62 basis points of cut. So markets are starting to think that you're going to see a 50 at the December meeting or at the January meeting. So this is something to be looking for. But in a way, if this ends up weakening the euro, it means it's going to be better for European exporters. We've heard how many European exporters, particularly in Germany, are really struggling really badly right now. So I'm sure they would welcome that. Furthermore, if you do end up weakening the euro a bit, it might actually cut off Trump's ability to actually move forward with those tariffs and actually sort of push things even further. So I have to confess at the minute, I'm a little bit surprised that given that the race has been going Trump's way, I'm surprised that actually euro-dollar is holding up as well as it is.
OK, really interesting. Christine Lagarde's early revenge. But I want to keep you in Europe and switch focus to the UK because, of course, we've got the budget. Do you think that Rachel Reeves, whatever she does, is going to be shrugged off by the gilt market?
Yeah, so we've heard a lot, haven't we? A lot has been leaked over the course of the past week, and so I think, broadly speaking, the contours of what is going to be announced yesterday are now largely in place. There are going to be questions around what does this mean in terms of gilt issuance, what does this mean in terms of front-loading spending. So there's still going to be a lot of interest in the details. I think the one thing that does trouble me, though, is that a lot of the analysis in the UK budget is assuming that interest rates come down nice and happily because inflation is coming down. But I do see, notwithstanding the last inflation print, still a bit of a nagging doubt that inflation in the UK may remain a bit elevated. And ultimately, if you're sticking on sort of additional costs to employers in terms of national insurance contributions, that's another reason why you might actually see businesses move to pass on those sorts of costs. So I'm a little bit wary of assuming that you have this very benign trajectory in UK inflation and UK interest rates. And for me, that's where you could actually see some risk to the budget because interest rate expenses are now such a big budget item, aren't they, in the UK? And so if we end up overshooting there, that's going to end up limiting the room that Rachel Reeves has. And so from that point of view, and given what we saw in 2022, I still think at the back of the investors' minds, there's still a bit of ongoing vulnerability there.
So some ongoing vulnerability. So, Mark, does that leave you playing gilt markets into the budget or leaving it well alone for now?
So at the moment, I'm happy leaving it alone. At the moment, I'm not sure that there's such a clear trade. I would be more inclined to actually be positioned short in the British pound, again, relative to the dollar. We like the dollar as a theme going into the US election. But when it comes to the gilt market, I'd infer that the Bank of England, Andrew Bailey, seems like he wants to cut. He wants to be dovish. I think we will see a rate cut at the November meeting. But thereafter, I think it's going to be sort of more questionable about how much more can actually be delivered. So I'd be more inclined, if you push me, to be on the short side rather than on the long side of British gilts. But at the moment, I think there's probably more asymmetry in the pound than there are in gilt prices.
A lot of the focus on the rising yield story this is going back to the US more broadly, has focused on the possibility of this being Trump trades. You acknowledge that, but also the strength of the US economy and some of it perhaps coming from that direction. We don't seem to talk but the election is still on a knife edge, of course, and we don't talk all that much about Harris trades. Some people talk about the fiscal story being live, whoever ends up in the White House. If we do get a Harris victory, what's mispriced at the moment? What moves?
So that's another good question. I think that if we do see a Harris win now, it will come as something of a surprise. I think that we will see a weakening of the dollar in the short term, albeit I'd say that if growth remains strong, US growth exceptionalism in the US is probably going to see a bid then return to the dollar after some initial weakness. But you will see that move. I think you'll probably see bond yields moving a bit lower. There is this fear that Trump will be more inflationary, and putting that fear to bed, you could see bond yields go down. You may see equity markets retrace. Equity markets have been pushing higher. And, of course, the Bitcoin's going to go down, isn't it, if Harris comes in. So there'll be a reversal of some of the recent trends that we have been witnessing. But the one thing that I would infer is it doesn't really matter too much to me who wins this US election in terms of fiscal policy. I think that fiscal policy is going to be profligate regardless. We're going to see a 7% budget deficit next year, almost regardless of who wins this election. So I wouldn't really read into this a narrative that actually a Harris win here is going to be a really good piece of news for the long end of the bond market.
All right, Mark Dowding, CIO at RBC Bluebay Fixed Income. Great to have you on the programme in such a busy week for looking ahead to the US election as to that UK budget as well. We thank you as always. But I want to get back to the earnings picture because we have had a raft of results this morning, not least from Novartis, and those shares are down 3.6% currently, despite having boosted its annual profit guidance this morning for the third consecutive quarter. The Swiss drug maker seeing gains from rising sales of its blockbuster drugs for psoriasis and cancer. But let's take a look now at what is really putting a bad mood on the market for traders this morning. We can speak to the CEO, Vas Narasimhan, CEO at Novartis. Welcome to the programme, Vas. You've raised your profit guidance for the third straight quarter. Traders not convinced. Tell us about your outlook for the year ahead.
Look, we had a great quarter three, and when you look at the last 2 years, we've had consistent, very strong operating performance. Currently in the quarter, we grew 10%. Year to date, profits are growing 20%. Very strong pipeline and growth performance from our key growth drivers. So we feel really good with where the company is at the moment. We've been able to raise both top and bottom line guidance. And I think importantly as well, that keeps us on our trajectory longer term to deliver on 5% sales growth out to 2028 and achieve a core margin of 40%. So we've got great momentum completing 2024, and we should be able to continue that momentum into 2025.
Well, I think from analysts' notes, what's worrying them in particular is the expiration of these US patents. What reassurance can you give investors there?
Look, patent expiries, of course, are part of our business. What's exciting for us, coming out of 10 positive phase 3 studies, we have now these new growth drivers that allow us to replace our sales. So given that, we expect to be able to grow in 2025 on the back of such great performance from our breast cancer medicine, Kisqali, which recently got expanded into early breast cancer with an approval in the United States and a positive opinion in Europe. Very strong performance from Cosentyx, our immunology medicine that's looking really strong in the US and in Europe. Kesimpta, our multiple sclerosis medicine, and every one of these medicines have protection into the 2030s. And then we have some new launches, a drug called Fabhalta, another drug called Scemblix, also with very long patent life. As those medicines ramp, it's a normal thing in our sector to have to overcome near-term patent expiries. So what is, I think, strong for our story is we can maintain a 5% 5-year sales growth CAGR despite having some expiries next year. So really good underlying performance and a long-term trajectory that I think is positive.
Vas, any further guidance you can give us further down the P&L, though? Because you referenced the years ahead sales guidance there. But I think the market looking for a little bit more commentary on 2025, given we have those patent expiries, Entresto and Promacta being mentioned by some of the analysts this morning.
Yeah, absolutely. So already you've seen year to date, we're at 39.6% on the core margin. We've committed to getting to 40% by 2027. Actually, in quarter three, we actually were above 40%. So we feel very comfortable. We'll see consistent margin expansion over the coming years. That consistent margin expansion should comfortably get us to that 40% plus margin. And of course, if we can go higher while fully investing in R&D and marketing and sales, we'll certainly do that. So I think the sales growth and the margin expansion delivery is continuing consistently. So yes, we'll have some expiries next year, but I think for long-run investors, we make an outstanding value proposition.
Okay, and a little more on the cost side of things. Some analysts do quote, Vaz, that your management's strong control of sales and marketing expenses has significantly benefited the 2024 profitability outlook. Do you see all of that as something that you can continue, something that can be replicated?
Look, I think we've consistently delivered that margin expansion. If you look over the last 8 years, the margin expansion in the company is over 1,200 basis points or 1,000 basis points, certainly. And I think that demonstrates we have strong cost discipline and we can drive the top line while maintaining relatively steady marketing and sales expenses. So our expectation is with all of these new launches, we'll still be able to manage our M&S and G&A lines, maintain $10 billion of R&D expense, and then as we grow the sales, they'll continue to flow to the bottom line and lead to strong profit growth. You also saw extremely strong free cash flow in quarter three. We have a balanced approach to our capital allocation, which allows us to maintain a strong growing dividend and continue share buybacks as well as M&A as appropriate. So I think that overall story from a cash flow generation and operating income is very strong.
Vas, I want to ask you about the obesity pipeline in just a moment, which I know you've briefly touched on. But before we do, I want to circle back to that visibility into the next couple of years. And I understand that you have a big drug pipeline to kind of cushion perhaps some of the patent volatility there. I'm curious how a new administration may change that in the United States, given the FDA and the regulations there are also expected to change in 2 months, depending on who we have in office.
Yeah, I think regardless of who wins the presidency, our big focus is on legislation that hopefully continues to improve the overall innovation environment in the U.S. We want to see PBM reform passed. We want to see 340B, another government program in the U.S., reformed. And we want to see the IRA shifted to better balance small molecule and large molecule medicines. But we factor all of that into our pipeline and factor that into our guidance that we've now given. So I think regardless of who wins the election, we should be well, I think, positioned to do well in the longer term. What I think will be really important now is that we keep the innovation cycle very fast, because with the IRA, certainly the timelines we have for some of our medicines industry-wide is going to be compressed. So the winners are going to be those who can consistently deliver on their pipeline quickly.
Well, let's dive into that pipeline then, because again, I'm going to connect those two issues. Some of the key regulatory issues for some of your other pharmaceutical peers is around the obesity drugs, where so much of that consumer demand comes from the United States and, of course, subject to those kind of regulations. You're actively saying that your pipeline isn't really dependent on the obesity story, but do you think Novartis may be missing out on that wave, that yes, you may be treading water and you may be having other exciting drugs in the pipeline, but not able to fully capitalize on that trend and the kind of unwavering demand you're seeing from the States?
Look, I think we're at peak obesity hype cycle, and I think one of the things I've learned over the years in our sector is you have to continue to invest where you have a unique advantage. In obesity, in this first wave, it's very well serviced by companies that have launched the first generation of injectable and likely oral GLP and GIP-1 medicines, and we'll see how that market evolves. Also, I think in general, analysts have very bullish forecasts, and then as the reality sets in, we'll see how the market develops. I think what's important for us is to invest heavily where we have an advantage. Radioligand therapies, we're the market leader. This could be a $20 billion segment for the long run. CAR T, so cell therapies for immunology, again, we're a leader. siRNAs, so small interfering RNAs for a range of diseases, we are one of the leaders. Cell and gene therapies, we're one of the leaders. So investing in those areas where we can build an advantage for the next decade is what our focus is.
Vas, give us a final update on Pluvicto in particular. Your numbers came in slightly above the estimates when it comes to that drug. What does the growth cycle look like? What does demand look like? A Pluvicto update, if you will.
Yeah, Pluvicto, our radioligand therapy for prostate cancer, I think a revolutionary medicine. We see steady growth, and we expect Q3, Q4 to be largely in line. But what's exciting is the new indication, which we announced today that we filed, which will hopefully get approved in the first half of next year. That triples the population eligible for Pluvicto. Then we have another 2 studies that are on track to be reading out in 2025 and 2026. Will give us more expansion of Pluvicto. And then behind that, what's probably not been fully appreciated by the markets is the scale of our radioligand therapy pipeline. We have now 7 different medicines in the clinic that target a range of solid tumor cancers. And I think the opportunity there to build a lasting leadership position in radioligand therapies, while the world is focused on obesity, we'll hopefully be able to address a whole range of cancers with a revolutionary technology.
All right, Novartis CEO Vas Narasimhan joining us on the program with some pretty lofty goals. We appreciate your time, as always, up after their earnings report. Shares still down over 3%, though, of course, as we interviewed him. Sticking with the earnings story, so what's coming up on the show? We're going to go from pharmaceuticals to banking. A closer look at the earnings results of HSBC, one of the best performers on the Stock 600. Santander, on the other hand, one of the worst. We're going to dive into the banking sector next. Stick with us. This is Bloomberg.
Welcome back. This is the opening trade, Tuesday, 29th of October, and we see European equity markets are a little bit, we see them stronger this morning, in fact. 24 minutes into our trading day, let's get an update on stocks, individual stocks on the move. Here's Joe Easton.
So we got really different pictures in the UK banking stocks today. HSBC rising, pretty much what we saw with the Hong Kong shares, gaining almost 4%, better than expected net interest income, and also that $3 billion buyback boosting that one. But Santander going the other way. Now the lending margin's a little bit weak, but also you have to suspect that the halting of the UK results is weighing on that company. I know you were discussing with the management earlier. He gave a figure somewhere around 600 million wouldn't be material for the company, but we don't yet know how much that is going to cost. So it is one to keep an eye on in Santander. It seems that is taking some attention away from the main group results today. Then in Germany, we've got another couple of stocks going in different directions. Lufthansa, now this one weakening. They are kind of guiding towards lower capacity in the year ahead, according to analysts. Also, their costs are higher, excluding fuel, though. It looks like wages potentially weighing on that one today. Adidas, meanwhile, continuing the rebound. Remember, this one slumped a lot a couple of years ago when they ended their partnership with Kanye West or Yeezy, but it has risen around 50% over the past year or so, and it's gaining a bit more now following some better than expected sales from that company. Then over in med tech now, this is actually, believe it or not, something we don't cover too much. It's dental implants, but it is a $20 billion company listed over in Switzerland. We've done Novartis, but the big one moving lower is Straumann, dropping. That's the biggest decline in around 6 months for Straumann today. A big decline for that one. Finally, one morning call. We're all looking ahead to the budget tomorrow. Will we get news on inheritance tax? Will we get news on capital gains tax? Bank of America downgrading St James's Place to neutral from buy ahead of that, and that stock falling 3% on the London market ahead of that key budget tomorrow morning.
Joe, thank you very much. Yes, we'll certainly have a lot of focus on that in tomorrow's programming. In terms of where we are across European equity markets right now, giving up earlier gains, pretty flat now across the Stock 600. More on the markets when we return. We'll also talk about the US elections. With just a week to go now, we will dive into what's at stake for relations between Washington and Brussels. We'll be joined by Bruno Maçães, Senior Advisor at Flint Global and former Minister of European Affairs in Portugal. This is Bloomberg.
I think we have to be lucid on our situation. Europe is no more the top priority of the US. The US top priority is US, which is normal and fair.
Look, almost any way the American election comes out, I think there's a recognition in Europe that we need to be more agile, more dynamic, more competitive, not just against the United States, but also against a rising Asia. And that's, I think that's very clear. People are aware of the change, getting ready. for what lies ahead.
We'll work with our American partners independently for who will win the election. The Biden administration was able not only to protect the American interests, but also to keep alive and even strengthen in some way the multilateral framework.
European business and political leaders speaking there about the upcoming U.S. election and what it means for the region. Of course, we're only 1 week out until Election Day in the United States. We want to zero in on what's at stake for relations between Brussels and Washington. It's part of our daily series focusing on the issues facing Europe in the battle between Kamala Harris and Donald Trump. We're joined now, I'm pleased to say, around the table by Bruno, Maçães, Senior Advisor at Flint Global and former Minister of European Affairs in Portugal. You have a very, very clear and kind of poignant take on how Europe is going to be interpreting this. And it feels like what we've heard time and time again is that a Trump 2.0 is a bad thing. Is it as simple as that?
I think it is. You know, the relations were very good over the past 4 years. You had people like Antony Blinken, Jake Sullivan. They were Europhiles. Blinken, a fluent French speaker. Sullivan talked to von der Leyen, I'm told, once a week, once every other week. That's not going to happen. People around Trump, I'm not going to give names, but people around Trump, there are a lot of people that could qualify as Europhobes. They really don't like Europe. And so the policy is going to be dramatically different, I think, on an everyday basis, but also long-term measures like tariffs are going to have a huge impact on Europe.
So one of the, and we played some sound there from Emmanuel Macron, but one of the arguments in Europe here as well is that in the absence of that, perhaps, alliance that has been so strong for so many decades, you could start to see Europe kind of catch up a little bit. But does that catch up, is it restrained or is it limited by the fiscal handcuffs that a lot of these European nations have? Is this a little kind of lose-lose situation at the end of the day because of the budgets?
Yeah. We saw in the Draghi report that was published a few weeks ago, he called for more investment, stronger industrial policy, but that can't be done with the restraints that we have. So even someone like me that 10 years ago, we're trying to solve the Eurozone crisis, that was a different time, and I think now we need looser policies if we want to catch up with China and the US.
And thinking about how Europe prepares, then, Bruno, for another Trump presidency, if that's what we get. I mean, the whole thing is on a real knife edge, isn't it? But if we did see another Trump presidency, you've been talking to people in Brussels recently. Are they preparing for Trump 1.0 again, or are they preparing for something very different?
They're still optimistic. They think they can talk to Trump. And last time around, in the end, it wasn't that bad. Remember, Jean-Claude Juncker was able to talk to Trump. They apparently became very good friends. And Trump, remember at the end, there was a discussion about imposing tariffs on autos, German auto industry, and Trump never did it, in part because COVID happened and he was busy with other things. So last time around, he wasn't as dramatic as some people feared, and there's optimism in Brussels that you can deal with Trump. There's a discussion going on whether you should be tough or conciliatory, whether you should offer or transactional, whether you should offer Trump something or whether you should, put some threats on the table.
I mean, that's the word that's used often, isn't it? Transactional. That he will come at you hard with some policy. He may intend to implement that policy, or he might just be looking for something from you to stop him doing so. So are there a lot of people in Brussels, then, that are counting on him being quite transactional?
Yes, and you could offer Trump more access to the European market for American agriculture, for example. This is being talked about in Brussels. There's a difference, a dramatic difference from last time. That's Ukraine, where the emotions are very high and where Trump could really force us Europeans to change our policy in ways that we don't want to do it. So that, I think, is going to be different from discussions about tariffs and others where, in the end, the transactional approach could work, but on Ukraine, it won't work.
Well, how fast are they planning for the commitment in Washington to NATO, to Ukraine, to unravel if Trump's elected?
Right. It's not so much that he would get out of NATO, but that NATO would be less active, less visible, that many of the discussions there would be frozen, paralyzed. This is what people worry about. On Ukraine, Trump has already been clear that even before he takes the oath in January, even before that, he will try to reach a deal with Putin. So at that point, all options are open. It will become very difficult. Many European countries will be firmly against such negotiations. Others will jump on board. This is another problem, that Trump will most likely divide Europe. People are worried about that.
But I mean, for as clear as you're being about Trump 2.0 being a bad thing for Europe, I thought your New Statesman essay was fascinating. You said no one you know is voting for Kamala Harris. Do you want to share with our viewers why you were so convinced about what you saw in Michigan, why you think that Trump's so appealing to the low-income vote?
So I went to a Trump rally in Michigan. I recommend to everyone to go. It's incredibly educational. And what you could see is that Harris has a lot of problems. The auto industry in Michigan is suffering. People in general are suffering. Inflation has been a huge drag on people's plans and economies. And then, of course, there's the question of Gaza. So Michigan has about 300,000 Arab Americans. And what I saw there is that, people talk about Gaza and Lebanon all the time. They go to funeral services of people that died in Gaza or Lebanon. And these people tell you that they will never vote for Harris. They won't vote for Trump either. But if they don't vote for Harris, it's, 300,000 votes potentially. It could decide the election.
Let's bring it back to Europe in particular here. When we're talking about how the EU is now interacting or responding to things like tariffs or overcapacity, we've seen them been able to pull certain levers with the likes of China, for example. What levers can the EU pull with the United States?
It's very difficult. So you can appeal to the values of the transatlantic alliance. That doesn't seem to work very well with Trump and the people around him. I think last time around, Trump in the end got a bit worried that the EU also has some economic clout and it can punch back. And that's probably where Europe can, if it's done diplomatically and behind the scenes, can explain that it's also possible for the EU to apply tariffs to the U.S. on some to pick some constituencies in the U.S. that would suffer and constituencies that are close to Trump. So I think this is the strategy that has to be developed. I'm told there are already working groups that meet once a week in Brussels to try to decide how best to do this. But again, there's this divide. Should you be tough or should you be transactional and even have sort of a charm initiative to try to bring Trump online? I don't see anyone in Europe that can do that. Last time there were a few people, including Boris Johnson, famously, but also Jean-Claude Juncker. This time around, I didn't see a candidate to play the role of bridge between the EU and Trump.
It's a crucial point that you bring up, the carrot or the stick. What is the most effective strategy? Right. The stick being, of course, the Trump 2.0, but it feels like we've done the carrot as well under the Biden administration, the likes of the IRA, for example. So if Harris does continue that policy, if the EU can't retaliate with tariffs or levies or quotas or whatever that may be, can they subsidize domestically to kind of counter some of the incentives you get in the IRA?
It seems very difficult, right? The news we get from Germany are not encouraging. The economy is in really bad shape and there's no fiscal space whatsoever. Until the elections, there won't be any changes in how the current government approaches fiscal policy. So I don't see any chances of doing that. By the way, with Harris, we shouldn't assume that everything is going to be as good as it was with Biden. Harris is a very different politician. She won't invest the same kind of capital that Biden invested on the Ukraine policy. She will try to continue the policy, but she won't invest the same kind of capital, and she won't go against a Republican Senate and a Republican House in the way that Biden did. So I think there's trouble ahead, no matter who wins.
Where does the military story in Europe go then, with that in mind? Because for years, some have called for, and the French have been vocal on calling for Europe to have more of its own cross-European, pan-European military capability. Others have been more sceptical of that. There's the NATO umbrella currently, but that could be furloughed, as you suggested. So where does that leave Europe and its build-up of military capability?
We have to build up. One diplomat from one of the major countries told me last week in Brussels that we have to align with the U.S. on China policy because we're under threat from Russia and we need the American nuclear umbrella. So until we have our own nuclear umbrella, we're extremely dependent. So this is how people are thinking. It's obvious that we need to become less dependent on the military side of things so that we can become more sovereign on the economic side of things, but it will take time. And of course, it will be difficult because even that independence, I've seen the latest numbers, maybe 35% of weapons procurement comes from European industry. That has to be increased dramatically. Otherwise, we remain dependent.
Will that be the aim, though, to get that level of independence for European foreign policy and military policy? That hasn't been the case for decades, obviously.
We may have the same decisions that the U.S. has, but we need to have the capacity to be on the table and to be taken seriously by the U.S. This is the mainstream view in Brussels right now.
So one of the key issues that I think is going to be top of mind for a lot of the Europeans as soon as the new president is elected, in addition to defense spending, is going to be what happens to steel tariffs and liquor tariffs as well in retaliation. What is the kind of touching point there? How do you see that getting resolved, if at all?
I don't see that getting resolved. I see new problems piling up. So Trump has announced that he will have a 10% across-the-board tariff, and that will also impact European industry. We're seeing forecasts and studies showing that perhaps 150 billion of EU exports to the U.S. may be affected, may be reduced. That's about 25% of our exports to the U.S. So this is the kind of numbers that are being talked about. With Harris, I think we'll have more continuity. But, you know, we saw that Biden didn't really remove the tariffs that Trump had imposed. And I don't see, I think Harris will be politically weaker than Biden. And I don't see her being able to changing some of these fundamentals. It's very obvious in the campaign that what is coming from the American public is more America first. That's what I saw in the rally. People are suffering in some of this industrial heartland in the U.S., and they want more tariffs, they want more investment in U.S. industry, they want more retaliation against other countries. And so this is the landscape no matter who wins.
All right. Bruno Maçães joining us around the table, Senior Advisor at Flint Goldman, former Minister of European Affairs from Portugal, of course, giving us some real insight into how the Europeans are thinking. He's not the only one. Of course, the election is top of mind around the world. Citadel's Ken Griffin spoke earlier from FII in Riyadh. Take a listen to what he had to say about the U.S. election.
The expectation today is that Donald Trump will win the White House in just a few days. We'll know shortly. And big picture, the reduction in uncertainty is almost always positive for asset prices. And we're at that moment of peak uncertainty. It is a race that Trump is favored to win, but it's almost a coin toss.
All right, Ken Griffin there, the founder and CEO of Citadel, talking about the fact that he's actually expecting Trump to win. And this is what you're seeing in the betting odds. This is what you're seeing in the financial community, even though the polling odds are still 50-50.
Yeah. And he did say that as well, didn't he? That, you know, it is a bit of a coin toss. I thought it was interesting with that in mind, talking to Bluebay earlier on and saying, OK, so if the markets are increasingly talking about a Trump win and positioning around that, what does it look like? What is mispriced if we get a Harris win? Because that, for the market, has to be something of a concern. And he was talking about how, that might be dollar weak in the very short term. But then the growth story comes back and actually the dollar picks up again.
I mean, just as a British observer, Kriti, I thought it was really interesting when you were pointing out to us off-air the other day the difference in importance of betting odds in the US election. Do you want to just briefly tell us why?
Yeah, sure. I mean, this is kind of my big pet peeve here. I mean, betting on the election it's basically gambling in the United States. You're not really allowed to do it to the same extent that I think you are in other parts of the world as well. It's crucial as well because so many of the financial community look at betting odds, but it's a very light pool of people, and it's largely kind of driven by a lot of international. Yes, and it's driven by a lot of international bettors as opposed to domestic bettors.
I thought that was fascinating. Such a crucial part of British culture, gambling. But we're going to keep getting back to the gambling on the stock story later in the programme. We've been looking at Lufthansa shares off the back of their results this morning, actually lower despite the airline reporting third quarter revenue on strong travel demand. So we'll dive into what's happening at Europe's biggest airline group next. Stay with us. This is Bloomberg.
There's no question the deal-making environment is improving. And when you look at what's going on with technology and the investment that's necessary, to power AI, I think that's a tailwind for deal-making over a period of time, too. Yeah. A lot of change, a lot of opportunity. And when there's change, leaders are constantly looking to make sure that they're positioned strategically to have a leadership position as the world evolves.
Well, I know you've also been making a big push into your alternatives business. Private credit is an area of focus. What is the opportunity that you see there? Because it really feels like that has become the major focus of the market. Many different players are looking to get involved in that space.
Well, we've been in the private credit business for over 30 years. We have $140 billion of private credit assets. We've been a leading private credit player since the 1990s. What I would say is there continues to be secular growth around the opportunity set for additional private credit formation, and we're very, very well positioned, given the way the firm sits, to be a very, very unique player in that. Obviously, in our asset management business, we manage significant private credit assets, but we also have one of the leading syndication franchises. So we have an ability to originate and distribute in addition to be an investor through our asset management business. That's a very unique combination. I think it positions our firm very well. And you will see, in my opinion, continued secular growth in private credit formation. I still think we're early in that cycle.
What do you think lower interest rates do for the private credit landscape, though, given so much of the debt is floating?
I think that private credit, it's not immune to lower interest rates, but there are different ways that we can finance activity. And private credit's a very important part of that. People use private credit as a very, very broad term. Are we talking about insurance companies financing investment-grade companies? Are we talking about investment-grade financing? Are we talking about below investment-grade corporate financing? Are we talking about direct lending to small and medium-sized enterprises? These are all different forms of private credit. And the reality of it is, regardless of what the interest rate environment is, people need to finance. And so, of course, in the short term, movements in interest rates have an impact in short-term activity. But we're talking about the engines of finance that drive capital structure in a whole variety of ways. This is not something that's cyclically tied to short-term interest rates.
Goldman Sachs CEO David Solomon speaking exclusively to Bloomberg in Riyadh. That conversation coming to us from the Future Investment Initiative taking place there in Riyadh. Let's have a quick look at where banks are trading, because there they talked about the interest rate environment, and that very clear having an impact on Banco Santander. Third quarter earnings came in this morning with a little bit of disappointment around the interest income amid the shift to the lower interest rate environment. And that, plus the fact they delayed their UK earnings because of that motor finance ruling at the back end of last week, both of those factors weighing on the Santander share price. On the other hand, HSBC doing well on the back of the Chinese push towards stimulating demand in that economy. It certainly got people excited about Chinese stocks again. And HSBC's doing well on the back of that, plus a buyback in the mix as well. So we see mixed fortunes for European banks then, Lizzy.
Yeah, sector-wise across the stock 600, you're looking at travel and leisure at the bottom of the basket, down 0.4%. And within that basket, Lufthansa shares at the very bottom, down 2.4%. And that's actually despite reporting record revenue in the third quarter. So 2.5% down this morning, specifically for Europe's biggest airline group. And it actually said that it plans to increase capacity in the fourth quarter and that bookings for November and December are above last year's level. So let's make sense of this. We can bring in Bloomberg's Oliver Crook from Berlin. Ollie, just talk to us about the discrepancy here between the share price moves and the results.
Yeah, so listen, in terms of the results themselves, they were really a confirmation of the guidance that we got from Lufthansa, but we should say there was already a reduced guidance that they gave back in the month of July, because it's been a sort of very difficult start for the airline industry and Lufthansa more particularly. What I think is interesting, and I think you pointed to this in the introduction there, is that they did have record revenue in the third quarter. However, if you look at their EBIT and their profit, that actually dropped from a year earlier, which would indicate that despite the fact that that revenues are rising, that actually that profitability is being squeezed, in large part also due to costs, right? This is one of the issues. The other thing that they're pointing to, though, is despite the sort of harder beginning of the year, that they're actually going to be able to increase capacity in the fourth quarter. They expect that demand to sort of steady out. And there are a couple of other interesting kind of smaller notes within the earnings release that I think are worth mentioning. That demand, particularly for business and for first class, is continuing to hold up. So the upper end of the segment is still doing well for Lufthansa. And the last one I thought was interesting is they've canceled their daily flight from Frankfurt to China, in large part because of fuel costs, because they can no longer fly over Russian airspace.
Ollie, talk to us about the other major German earnings story this morning. That, of course, is Adidas. Shares higher by about 1%. What's going right at the shoemaker?
Yeah, if you look at their earnings release, it seems like there's actually quite a bit that's going right. So overall, they did sales that were up by 10% in the third quarter, which was a confirmation of what we heard from them in their pre-release a couple of weeks ago. Their gross margin shot up to 51%. That's up 2 percentage points from before. And of course, what we're always watching, Kriti, when we're watching Adidas, is the revenue that they get from that Yeezy inventory after that relationship sort of exploded catastrophically last year. They still made 200 million euros worth of Yeezy merchandise that they were able to sell. If you look at the regional breakdown, this gets quite interesting. In Latin America, they're up almost 30%. Europe up 18%. China, even despite the sort of struggles there for the economy, up 9%. And North America down 7%. What's interesting, and this gives us the opportunity to use our favorite earnings term, ex-Yeezy, actually North America would have been positive territory, but because of the terrible comps year on year, that actually was put into negative territory. When you compare them to their sort of big brother, if we can say Nike, and you look at the market cap between these two companies and what we've seen over the last couple of years when the new CEO has taken over here at Adidas, there used to be a $200 billion market cap difference between these two businesses. You can see there on the right end of the chart, that has narrowed to just about 80 billion euros, which isn't nothing, but really tells you sort of the difference in fortunes that we're experiencing right now between Nike and Adidas.
All right, Oliver Cook in Berlin, we thank you so much for breaking down two of the major earnings stories out of Germany this morning. As we, of course, monitor those share prices, let's talk about what we've got in the day ahead. A lot of the focus switching over to what's going on in the States at about 2 p.m. UK time. You do get the JOLTS and consumer confidence data as well. It'll be about 10 a.m. local in the United States. Plus, like those consumer confidence numbers as well, plus a slew of earnings. McDonald's, Chipotle, Visa, PayPal, really getting a take on the American consumer. Plus, of course, the highlight, I think, maybe of the week in the earnings picture, and that, of course, is Alphabet tech earnings alongside Snapchat and AMD. What does that say about the consumer? What does that say about ad revenue? And, of course, the major cloud services that Alphabet is trying to break into. In the meantime, let's dive deeper into what markets are expecting from some of that data that we're going to get. Bloomberg's Valerie Teitel joins us around the table. It's an exciting 9 days, I guess, in the bond market. What is going to be the most volatile for the bonds?
Look, we get a lot of labor market data out from the U.S. today that has a tendency to have surprise. It surprised us last month, coming in strong, showing a tightening labor market. We're going to be very sensitive to any more hints if this is a sustained move in the U.S. labor market towards tightening, or if all last month's data was just a blimp. It starts today with the JOLTS data. Then we get the private payroll data on Wednesday, followed on Friday by the big non-farm payroll report. We're going to be looking at the job openings per unemployed worker, and the data out today. It has seen a teeny tick higher in last month's data. Bloomberg Economics does see it ticking higher again today, but does not see that tightening move in the labor market to be sustained in the coming months.
So we are seeing that yields are ticking a little higher this morning over in the United States, and I think the same applies to Europe and the European scene. Is that just read across from that global bond story? Is this a more European dynamic?
Look, we're seeing a decent underperformance in European bonds this morning, and it makes me think that we're starting to see some profit taking ahead of the U.S. election. We know that a very consensus position has been to be long European bonds, be short treasuries, because of the growth dynamics diverging and the monetary policy dynamics diverging there too. That 10-year spread has moved 60 basis points nearly in a straight line just in the last month and a half. So, you know, is this maybe a sign of what's to come, Anna, this week, that we could be seeing more profit taking on these Trump trades as we get closer to the election, and investors want to de-risk ahead of the biggest event risk of the year?
OK, Valerie, thank you very much. Valerie Teitel with the latest on the markets. A lot to think about then when it comes to some of the data, the Fed conversation.
Yeah.
That's even before we get to the election. You know, there are just so many moving parts for bond markets to keep an eye on for all asset classes. We've seen Bitcoin, of course, on the rise.
Yeah, but in the face of all the volatility, you're still seeing green on the screen in this equity market and real outperformance in those French stocks as well, which we, of course, know we took a very big beating in last week's trading as well. This morning, you're seeing the CAC 40 higher by about 0.6%. The underperformer, ironically, is the FTSE 100. That really is a tale of two oil stories, not to mention a tale of two banking stories. All of that and more, we're monitoring the oil prices, the banking story, and, of course, the bond market in the hours to come. Stick with us. Does it for the opening trade. This is Bloomberg.